Hello everybody, I hope all of you are doing really well. My name is Siddhant Mehta and welcome you all to Raftaar batch. This is part 3 of your chapter number 3, that is valuation approaches, and today we are going to learn everything about asset or cost based approach and fair value computation. So generally and in module it has been referred as asset or cost based approach, but in reality these two are different approaches. Cost based approach helps you value individual assets, whereas asset based approach helps you value an entire business. Hence these approaches are different approaches, but they are used interchangeably because they have a common foundation when it comes to value their assets or business. They both value them based upon cost to acquire, reproduce or replace it. Definition which is given in module for cost approach is: the cost approach values an asset based on cost required to replace its asset service capacity. Just change it to the asset, and it is also called as current replacement cost, or I said cost approach is also called as current replacement cost. The definition given in module is little complicated, but what it tries to convey is cost approach is nothing but a valuation approach which helps you to value your asset based upon cost to create a new asset which has similar utility, or cost to create a new asset which is an exact replica. Then asset approach means valuing a business based upon value of assets minus value of liability. It also tells you the methods to value your asset and also the methods to value your liability. We use asset approach for asset intensive business or investment companies. Like I said in part number 1, for these companies assets are important, hence we use asset approach for it. And you can also use this approach for valuing distressed entities or entities which are at liquidation, because for them they want to assess their value of assets so that the creditors can have maximum recovery from it. Hence these are the scenarios in which asset approach is used. Let's understand the methods which are there in cost approach, then we will understand about the asset approach, and then we will come to the limitations part of it. Let's first understand the methods which are there in cost approach. The first one is replacement cost method and the another one is reproduction cost method. In replacement cost method, you value your asset based upon cost to create a new asset which has similar utility. It is okay if this asset is not an exact replica. Here the cost to create has two meanings. One, if you can produce the asset, then it is cost of production, but if you can't, then it is the current purchase price of the product. Here, if assume I have to value my HP laptop, I will check what are the functions which are there in my HP laptop. Okay, it has a Ryzen 5 processor, it has 16 GB RAM, it has 1 TB storage. But when I go for the valuation of this asset, I understand that HP has stopped producing these assets. Then I will see, is there any another company which has similar functions like mine? Okay, there is one Dell laptop which has similar functions like mine. I will consider the Dell value for valuing my asset. This is called a replacement cost method. And what is a reproduction cost method? Here you value your asset based upon cost to create an exact replica of the original asset. So if I want to value HP laptop, I have to consider HP laptop only and not any other company's laptop, because I want to create an asset which is exact replica. Hence, I will consider HP laptop only. Then, what are the steps to derive value using these methods? First, you will understand your asset. Based upon that, you will estimate the cost. These estimate cost can be of from two methods. One is reproduction and another is replacement. Then you will assess, is there any obsolescence factor in my asset? Is there any physical or functional damage which is there in my asset? Okay, you understand it and you will derive the value for it. And then you will deduct the obsolescence value from your estimated cost, which will help you to derive the asset value. These are the steps which are there in cost approach to derive the asset value. Here, the replacement cost method is usually used by the insurance company to decide the payout. To give you an example, if there is one factory which got burned down and insurance company wants to decide what will be the payout, they will assess what will be the cost to create such a new asset which has similar utility, and based upon that they will decide the insurance payout. And reproduction cost method is usually used to value some old heritage buildings. Like if you want to value some old heritage building, you will consider, okay, what are the materials which are used to build such building, and at what price these materials are now available in the market, and based upon that you will value that heritage building. It can also be used to value some unique machinery. Like if Ranbir Kapoor came up to you and tell you to value this bad boy, and here the issue with this asset is you can't value this asset based upon market approach, because there is no comparable asset like this. This is one of its kind. Now you can't also use income approach for it, because there is no fixed rental income or fixed income you're getting from this asset, so you can't income approach. So in these situation you have to value this asset based upon reproduction cost method. Here you will value such asset based upon cost to create an exact replica of this asset, and based upon that you will understand the worth of this asset. What was the cost which was required for me to produce this asset? Based upon that you will decide the worth of this asset. This was your cost approach. Let's understand about asset approach. This is the approach which helps you to value your business. Here you value your business based upon value of assets minus value of liabilities. There are different values which you can take at the time of valuing your asset, but the most common one are book value, net replacement value, and net realizable value. Which value to take depends upon the situation of asset and nature of the asset. Like if I want to value sundry debtors, I will value it at book value, because that will be the value which will be reflecting the amount receivable from debtors. But if I have to value investment which is actively traded in market, then I will use market price and not book value. So let's understand the three values which are given in your module. The first one is book value. Book value is nothing but the value which is recorded in the company's financial statements, and this value will be recorded at historical cost and will be reduced by depreciation and impairments. The issue with this value is it will not reflect the current market value, and it is commonly used for accounting and reporting purposes. The second value is net replacement value. Here you understand the cost of replacing an asset with similar one at current market price. With the help of this you will get a replacement cost, that is replacement value, and then you will reduce it with the asset depreciation. If your asset has been used for 2 years, then you will depreciate this replacement cost for 2 years and you will get the net amount. This net replacement value is generally used for valuing a business as a going concern, because it shows the true worth of your asset in present economy, because here you are considering the current market price of the asset, but you are also depreciating it to make it similar of your asset, to make it asset specific. This is your second value, that is net replacement value. The third one is net realizable value. Here you estimate the selling price of your asset and then reduce it with the cost of required to selling it. Here we generally use NRV at the time of liquidation scenarios, and such values are generally lower than book value or replacement value, because you are selling your asset in distress, hence definitely your asset will get sold at a very discounted price. Now let's understand the various methods which we use at the time of valuation of assets. Then for fixed assets we use replacement cost, and we will adjust it for depreciation and economic obsolescence. Then for investment we generally use market price or secondary valuation. Secondary valuation is nothing but the comparable transaction which you have to see, and then based upon that you have to derive the worth of your investment, which is nothing but your market approach. For inventory, either you can value it by on cost or market price or NRV. For sundry debtors, whatever the amount which is receivable, based upon that you will value your sundry debtors. For contingent asset, whatever conservatively you think you can estimate that this will be the amount which you will receive, based upon that you value your contingent asset. Then development expenses, that is your asset under development. Whatever the cost which you have incurred for developing that asset, you will consider that cost in development expenses. And for intangible assets, you can either value at book value, fair value, net realizable value, or replacement cost. Which value to consider? The question will tell you which value you have to consider, but in case if question has not told you, then check whether you are valuing at the time of a liquidation scenario. If yes, then take NRV. If you are valuing a business which is of going concern assumption, then take replacement cost. This will be dependent upon the question. Now let's understand the valuation of liabilities. Here, if you want to value contingent liability, you will value it based upon probability based valuation. That means if there is a liability of 10 lakh rupees, which is a contingent liability, there are 40% chances that you will have to pay this 10 lakh rupees, and there are 60% chances that you don't have to pay this 10 lakh rupees. Now this probability will automatically become weights. That is 40% of 10 lakh will be 4 lakh and 60% of 0 will be 0, and your value of your contingent liability will be 4 lakh rupees. Now for taxes, whatever the amount which you have not paid, you have to book it as liability. For proposed dividend, whatever dividend which has declared but not paid, you have to book it as liability. And for reserves and provision, you have to separate your provision from reserves, and whatever is your reserves, you have to add it at the calculation of net worth, and whatever is your provisions, you have to check whether it is of liability nature. If yes, you have to book it as liability, or else reduce it from the respective asset. Now let's understand the limitations of cost approach. Like we understood, in asset approach, we value our business based upon our current assets and liabilities. We are not considering the future growth of the business. Hence, this approach ignores the future economic benefits which you are going to have. So it is not ideal for valuing a going concern, because going concern business wants to value them based upon their future growth and earnings. Hence, this is the limitations of these approaches. Then secondly, it is not considering the risk factors or competitive performance. It means you are not considering the risk factor. You are just calculating the worth of an asset based upon cost to create it. But what if in market there is no demand for this asset, by which these assets are getting sold at a very discounted price? You are not considering these scenarios, but only considering what is the cost to create this asset. Hence, you are not considering the risk factor. Secondly, you are also not considering the competitive performance. That is, you are just comparing HP laptop with Dell, but you are not considering that HP has a more competitive advantage in market like India than Dell. You are not considering that premium which HP will charge and that Dell laptop are not charging in India. You are not considering it. Hence, you are also not considering the competitive advantage. This is a limitations of cost approach. Now let's go through the illustration which is given in module for asset or cost based approach. Here there is one mistake which is done by the ICAI. They have calculated the fixed assets based on market value, and what we learn in asset approach, we calculate fixed assets based on replacement cost and not from market value. Hence, I have considered this example as it is from module, because if they ask same question in exam, you have to calculate the value of your business based upon market value. But in reality, it should be replacement cost. Let's understand this sum. R Square is a company whose replacement cost of net fixed asset is 150% of their book value. Liability and short-term assets market value are assumed to equal to their book value. That means there is no adjustment in liability and short-term assets, and the firm has 12,000 shares which are outstanding. Okay, there are 4 line items in assets, there are 3 line items in liabilities, and 1 is equity. First, at the time of calculating the value of business, we calculate value of assets. There is no adjustments in other 3 assets. There is only adjustments in net fixed assets. So we'll take 12 lakh rupees and we'll multiply it with 1.5, because the replacement cost of this asset is 150% of their book value, and we'll calculate the market value of all assets, that is 26 lakh rupees. Then we will consider the value of liabilities. There is no adjustments here, hence we consider this value as it is, and the total amount is 8 lakh rupees. To calculate the value of business, we subtract this amount with value of assets, and we will get the adjusted equity value, that is 18 lakh rupees. And to calculate adjusted equity value per share, we will divide this 18 lakh rupees by 12,000, that is the share outstanding, and you will get the amount 150 rupees. Now let's understand the last concept of this chapter, and then we will close this chapter. It is about fair value computation. In this section, we will understand what is a fair value and how to measure fair value. First, fair value is nothing but the value which comes out from an orderly transaction between market participants. Here, the orderly transaction means those transactions where the buyer and seller are not doing this transaction because of any forced condition. Also, they are informed people making informed decision. Hence, any value which comes out from such transaction is called as fair value. Here, the definition which is given by ICAI valuation standards for fair value measurement is nothing but similar one which is given by Ind AS 113. And Ind AS 113 says that fair value is nothing but the value which is based on exit price. Exit price is your selling price. This standard also tells you from where you have to assess this selling price. First, you have to assess it from principal market. If principal market is not available, then you have to go to the most advantageous market. Principal market is that market where there is a highest trading volume for your asset. If I have to value Zomato shares, I will check that there are two markets where Zomato shares get traded. One is BSE and the another one is NSE. Where there is a highest trading volume for Zomato shares, I will consider that market for the fair value valuation. Then if this market is not available, then I will go to the most advantageous market. Most advantageous market is that market where the net selling price for my asset is high. NSP is nothing but your selling price minus transportation cost minus your transaction cost. This will give you net selling price. Then in fair value measurement, we should reflect the market participant assumptions. That means fair value should be that value where buyer is willing to give, what buyer is willing to give, and not what seller is willing to charge. Then in fair value, we should also consider the characteristics of assets or liability being valued. That means if there is any some conditional or locational benefit, then you should also consider it at the time of calculation of fair value. That means if I have one plot, besides that there is a new 5-star hotel which got constructed, because of that my plot value gets increased, I will consider this locational advantage at the time of calculation of fair value. Then fair value should consider highest and best use of utilizing the assets or liability. If there are multiple uses of my asset, I will consider that use where there is a more profitable scenario for me. If I have one space, I can either give it for commercial purpose or I can give it for residential purpose. As we all know, the rent for the commercial is more than a residential. Hence, I will assume that I have given it for the commercial purpose, and based upon that, I will decide the fair value for this space. So fair value should consider highest and best use of utilizing the asset or liability. अब इसमें ना हम कैलकुलेशन में नहीं जाएंगे ज़्यादा, क्योंकि जो भी कैलकुलेशन वाले सम्स है वो आपको एफआर में आएंगे. आईसीआई ने हमारे सिलेबस में बस ये डेफिनेशन कवर किया है, और जो क्वेश्चंस आ रहे हैं वो बस ये डेफिनेशंस के ऊपर ही आ रहे हैं. जैसे कि फेयर वैल्यू के लिए इंडेक्स कौन सा है, then what is the price which we consider at the time of calculating fair value, then which market do we consider at the time of calculating the fair value. These are the questions which ICAI is asking in the exams. Hence understand this definition very well and cover each and every point of it. Then this is one basic concepts which they have covered, that what are the different perspective for saying fair value. For financial analyst, fair value nothing means the present value of entity in cash terms. For speculative investor, it is nothing but the arbitrage opportunities in the market. And for the CA, fair value is nothing but the transaction at arm's length price. This is your end of your chapter. अगर आपको बीटा कैलकुलेशन कैसे होता है ये समझना है तो आप ये सम देख सकते हैं, और अगर आपको डीसीएफ कैलकुलेशन कैसे होता है तो आप ये सम देख सकते हैं. ऐसे सम आपको एग्जाम में नहीं आएंगे, मैंने बस आपके रेफरेंस के लिए दिया है. दैट्स इट, दैट्स योर एंड ऑफ योर चैप्टर नंबर 3. इफ यू आर लविंग दिस कंटेंट, डोंट फॉरगेट टू सब्सक्राइब बिकॉज योर one click is enough motivation for me to keep going. Okay, tata, bye bye, see you in the next lecture.